Hey, thank you for taking the time to click on today's video. What's been going on in the market and why are we seeing the resurgence in the market the way that we have? In the last 2 months of 2023, it's been absolutely astounding. It's like somebody went over to the light switch and they flicked the switch and the market has come to life. Things are starting to go up in value. Our portfolios have, for the most part, probably completely recovered, if not maybe just slightly ahead of where they were in 2021. So what is the explanation of all of this new optimism that seems to be permeating the stock market? Well, the reality is that we all know you can't fight the Fed. And when the Federal Reserve is taking and they're trying to address the issue of inflation, which is something that they created years back when we had 2020 and we shut the world down and all of a sudden we bring the economy to a screeching halt and then we try to get the economy moving again. Well, they had to take interest rates. They had to drop interest rates to zero. They stimulated by sending money out to Americans. And as a result, there was pent-up money savings. There was pent-up demand to buy things. And guess what? As Americans, we spent, we borrowed. Corporations borrowed money and expanded their businesses. 2021 was flourishing. But that creates inflation. And none of us like inflation. We don't want to repeat it the 1980s and the 1990s. So the quickest and fastest way to bring inflation down is by taking and doing the opposite of what you did to get the economy moving just a year earlier. So what we've been introduced to over the course of the last 2 years is the pain of rising interest rates. The reality is this, that when you raise interest rates, you ultimately bring prices down. We see that corporations don't borrow nearly as much money. We notice that Americans are not building homes at the same pace that they were in 2020 and 2021. We notice that we don't even see cars being purchased the way that they were just 2 years ago. The reality is that this is how you shrink the economy and consequently you bring inflation down, you bring prices down. But guess what else driving interest rates up does for your retirement? It also takes the prices or the value of your shares, whether it's mutual funds, index funds, really doesn't matter what the asset class is, you're likely to see volatility occur as a result of raising interest rates. Now, what happened in the last quarter of 2023 was something that we all wanted. We wanted to be able to see the Federal Reserve decide not 1 month, not 2 months, but 3 months in a row, not raising interest rates. Because when you have just 2 months back to back where they don't raise rates, well, that's not a quantifiable pause. That's not something that really exemplifies the idea that they're completely done raising interest rates. However, you get 3 months back to back, and now that's kind of the official, unofficial word from the Federal Reserve that they're done raising interest rates. Now, have the interest rates been cut yet? And the answer is absolutely not. So why are we seeing the stock market take off the way that it has? We need to remember psychologically that the market is always going to be looking and predicting 6 months in advance. It's looking 6 months down the road. It's anticipating what's going to be coming, whether that's good or whether that's bad. But we are now to the point where we're looking at phase 2 of the Federal Reserve's project for interest rates. What are they going to be doing? Now they're going to be taking the interest rates that they have been increasing 11 times in a row, and they're now going to be reversing those interest rates. They're going to start trimming those interest rates and bringing those interest rates down incrementally, not down to zero because they're not trying to stimulate the economy back into another 2021 era. They're just trying to trim the interest rates so as to be able to keep inflation at a minimum, be able to obtain price stability, and guess what? When we see interest rates coming down, the cost of borrowing money becomes less. Well, guess what happens to the economy? It begins to blossom. It begins to grow. Profitability starts to come up. Corporations begin to borrow money again. They begin to expand. We see that cars are being purchased more. We see that homes are being built. And as a result, what does that do for the prices or the value of the holdings of your portfolio? Well, the good news is, in the same way that they went down when interest rates went up, now we can anticipate an ongoing interest rate decline with increasing asset values. That means that we're going to look forward to seeing the values of the holdings that we have in our IRA, our Roth, our non-tax qualified account continue to improve, continue to grow. Now, does this mean that we're not going to have any setbacks? And the answer is absolutely not. Those things are indeed going to happen, and we have to be prepared for that. But the point of this is not only to give you the context of what's been going on and kind of the why we've been seeing what we've been seeing, but it is a word of caution. You see, if we don't know history, if we don't pay attention to history, then they say that we're destined to repeat it. And we're going to see cycles, interest rate cycles, stock market cycles occur for the rest of our retired life. So the question I have for you is this. How much more volatility, how much more of the roller coaster are you willing to endure with your own portfolio? If 2020 was a bad year, if 2022 was a bad year, if 2023 felt like it was long in the tooth and it was getting really, really old really fast, well, realize that we're past that, the storm has passed, but that doesn't mean that we're not going to have more storms in the future. These things are a very cyclical cycle. Sometimes they're a very long-term secular cycle. And the reality is we need to learn from what we've gone through. Is your portfolio recession resistant at the very least? If the Federal Reserve does not trim interest rates fast enough, and it drives us into a recession. Are you ready for potentially what's going to be coming in 5 years if we go back through another interest rate cycle? You see, this is all something that is very real. It's something that has affected you tangibly, but you're now closer to retirement than you've ever been. So the question is, are you ready to stop the madness? Are you ready to break free of being in a position in your retired life where when prices are down because of external reasons, you're having to sell your positions at a loss just to get the income that you want? You see, these are things that I teach my clients to avoid. These are things that we can avoid safely. We can actually put ourselves into a position if we focus on income, if we focus on what the real objective of our retirement savings is for, and we begin to invest in that way for that purpose, now we can be in a position where we get the income, even if interest rates are high, even if prices are low. This is how we recession resistant, volatility resistant our portfolio. Have you done this for yourself? Have you done this for your retirement? If not, I encourage you, begin to watch the videos in our channel. Begin to educate yourself on how you can take your retirement to the next level so that you can get the retirement that you deserve. I'm Matthew Johnson. I so appreciate when you give us a thumbs up. I also encourage you, comment down below. We read all of the comments, all of the questions. We try to get back to individuals with questions. I encourage you to share this with your friends. If you like our little videos, hit that little subscribe button and that bell. We'll notify you each and every time we have a video. So until then, next time, I'm Matthew Johnson. Thank you so much for watching. And remember, it's up to you to make today a great day.